So a business will have lots of different types of income. They might have some trading income, they might have income from loan relationships like interest, they might have property income, and then there's other bits and pieces they might get which we call miscellaneous. And then finally we've got some dividends. So what I'm going to do then, I'm going to label these so we know that they are all different types of income that a company might have. And what we need to do is how to put all of this together in order to work out the total profits for a company. So if we were doing a corporation tax calculation, we would be given the information for all these various things. So we will need to know how to work out, for example, the trade income. So where do I get that figure from? Where do I get the money, the figures from for the loan relationship? Where do I get the money from the property income, and so on. Okay, so I'll basically add all of these together and that will give me my total taxable profit, which is sometimes referred to in books as TTP. So a company, remember, throws everything together. So we're going to look at each of these individually and see how they're calculated. And most of it you've done already, it's just reminding yourself how they work. So your trading income, remember, is your main business activity. So it's very similar to what we did in the chapter for individuals. But the main thing that's different is that you won't have any private proportion of expenses. So you won't have, private use of the car expenses, private use of the rent or the telephone. What you might have is what we call charitable donations. So if you see any donations under a gift aid scheme, companies do treat these as disallowed. We'll show you that they do get relief for them, but it's at a later stage. Other things to bear in mind, the last point, capital allowances, pretty much the same as an individual. I suppose the main difference is that you must consider that you can't have an accounting period for more than 12 months and there is no need to make private use restrictions. So when we did capital allowances, if we had a 16-month set of accounts, we work the allowances out for 16 months. A company can't do that. They will work out the allowances for, say, this example, for 12 months and then the capital allowances for 5 months. So they'd split it into the 2 periods. And you won't need to set up a private use column. So if it mentions any private use, you're to ignore it. We only did it for individuals when the owner had private use. With a company, it will always be the employees with a private use, so we don't need to do anything with it. Most of the other things that we did for trading income, like disallowing things like depreciation, entertaining, we'll do in more detail in a minute, but they are basically the same. So it's going to be pretty much a revision exercise. If we're looking at income from a non-trade loan relationship, this is any sort of income that's non-trade. I know that sounds like common sense, but it's not from your main business activity. So it's investment income. So investment income that you might receive from savings accounts or something like that. The main thing here to remind you about is that companies always get everything gross. So you never have to worry about grossing any income up. The property income is pretty much the same as what we've done already in terms of, looking at the rent you've received during the year and the expenses are pretty much the same, considering what expenses you've got, make sure it's specific to the property, like, cleaning, management fees, gardening, anything that's specific. The main difference it says here is interest payable on the loan for buying it will be dealt with under the loan relationship rules and therefore disallowed when you do property income. So if it mentions that the business has bought a property and they've used the loan to do that, any interest they're going to pay is going to come under that category. It'll be treated under the non-trade. And again, I'll show you in a question how that works. So you'll disallow it here, but you can have relief for it under number 2. What sort of miscellaneous income might you get that might be subject to tax? Well, sometimes foreign dividends might have to go in there, if it mentions them. I suppose other things you might have, capital gains, they're not mentioned in the notes, but they might come under that category. And then finally, we've got dividends from UK companies. Now, if they're UK companies, they've already been taxed in terms of the profit was taxed before the dividend was distributed, because dividends are only paid out of post-tax profits. So to avoid double taxation, they are not subject to corporation tax. So if you see any UK dividends, they're exempt, right? So they wouldn't need to go into this list. So a foreign dividend might, if it says it's subject to taxation, but if you see a UK dividend, you'll ignore it. It's not taxable.